Hey everyone, welcome back to Smart Dollar Resource, your go-to channel for all things finance and investment. If you're new here, make sure to hit that like button and subscribe for more insightful content. Today, we're diving into a fascinating discussion on When Genius Failed, the Rise and Fall of Long-Term Capital Management by Roger Lowenstein. This book chronicles one of the most dramatic failures in modern financial history, and there are loads of lessons to be learned. Also, don't forget to check out the affiliate links in the description below to help support the channel. When Genius Failed is a riveting account of the ambitious rise and staggering fall of long-term capital management, LTCM, a hedge fund that came to symbolize both the genius and the dangers of high-stakes financial strategies. Established in 1994 by John Meriwether, a former Salomon Brothers trading star, LTCM was originally celebrated for its pioneering use of quantitative strategies, managed by an elite group including two Nobel Prize-winning economists. The fund's strategy was initially incredibly successful, generating returns that far exceeded market benchmarks. However, as the narrative unfolds, we see how LTCM's reliance on complex mathematical models and extreme leverage led to its downfall. The 1998 Russian financial crisis exposed the fund's vulnerability, culminating in a massive bailout by major banks to prevent a wider economic collapse. This story is not just about numbers, it's a cautionary tale about hubris, market unpredictability, and the limits of human foresight in financial markets. When Genius Failed serves as an essential tool for anyone looking to understand the complexities and risks of the financial markets. Through the detailed chronicle of LTCM's strategies and missteps, readers gain insight into the workings of hedge funds and the potential consequences of using high leverage and relying solely on historical data for future predictions. The book highlights the importance of considering external factors that can disrupt even the most sophisticated models, such as political changes, unexpected economic shifts, and market sentiment. Additionally, it examines the role of ego in financial decision-making and the sometimes fragile nature of market stability. This book is particularly useful for investors, providing lessons on risk management, the importance of diversity in investment strategies, and the need for robust contingency plans. Understanding these aspects can help prevent the repetition of mistakes similar to those made by LTCM, fostering a more cautious approach in personal and professional investment endeavors. If you're diving into the world of finance, When Genius Failed offers an invaluable look into the high stakes of hedge funds and the critical importance of risk management. Firstly, the narrative style of the book makes a complex topic accessible and engaging. It reads more like a thriller than a financial textbook, capturing the dramatic rise and fall of long-term capital management or LTCM. This approach keeps readers hooked and simplifies intricate financial strategies and errors. Another significant advantage of the book is its in-depth analysis of risk. It exposes the underestimation of risk by some of the brightest minds in finance, providing a cautionary tale about the potential consequences. For anyone in finance, it's a stark reminder of what can go wrong when risks are overlooked or misunderstood. The book also serves as a historical document, offering insights into the mechanisms of financial markets during the 1990s. It details interactions with major banks and Wall Street, showing how deeply interconnected financial institutions are and how their fates can be intertwined. This context is crucial for understanding current market dynamics and the potential systemic risks. Moreover, the profiles of key figures involved with LTCM, including Nobel laureates and financial wizards, are not just informative but also provide a human element to the story. Learning about their thought processes, decisions, and oversights adds a personal layer to financial concepts, making them more relatable and understandable. Lastly, When Genius Failed highlights the importance of regulation in financial markets. The LTCM crisis contributed to regulatory changes aimed at preventing similar disasters. This perspective is beneficial for finance professionals and investors, emphasizing the need for oversight and the role of government in maintaining market stability. While When Genius Failed provides many insights, it's not without its criticisms. For starters, some readers might find the detailed accounts of financial strategies and transactions overwhelming. The book delves deep into specifics which can be confusing for those new to finance or unfamiliar with economic jargon. This complexity might deter a broader audience who could benefit from understanding the fundamental lessons of LTCM's downfall. Another limitation is the book's primary focus on a single hedge fund. While LTCM's story is compelling and educational, it represents a specific scenario. The uniqueness of LTCM's strategies and the extreme conditions of their failure might not fully apply to other financial entities or personal finance situations. This narrow focus might lead some to question the broader applicability of the lessons shared. Critics also argue that the book could have explored more about the psychological and cultural aspects within LTCM. Understanding the mindset and internal dynamics that led to such risk-taking behaviors could add another layer of analysis. The book touches on these elements but does not delve into them as deeply as it could have. Additionally, there is a perceived bias in how the events are presented. The narrative sometimes portrays the LTCM partners in a sympathetic light, potentially downplaying some of their misjudgments and the greed that characterized much of Wall Street at the time. This could lead to a skewed understanding of the events. When Genius Failed is more than just a historical account. It's a powerful educational tool that can enhance your understanding of financial markets and risk management. To fully leverage this book, start by focusing on the detailed explanations of financial instruments and strategies used by LTCM. Understanding these can provide insights into complex financial products that are still in use today. Reflect on the mistakes made by LTCM, particularly their underestimation of risk and over-reliance on models. These are crucial lessons for anyone involved in financial decision-making. Use these lessons as a benchmark to evaluate your own investment strategies and risk assessment methods. Ask yourself, are you considering all possible risks? Are your decisions based on solid data or assumptions? Discussion groups or book clubs can be an excellent way to deepen your understanding. Engaging with others who have read the book allows for a broader discussion of its themes and theories. Different perspectives can help highlight aspects of the book you might have overlooked and deepen your understanding of its lessons. Incorporate the historical context of LTCM's rise and fall into your analysis of current financial markets. Understanding the past can provide valuable insights into present conditions and potential future market behaviors. This historical perspective is crucial in a field as dynamic as finance. Finally, use the regulatory outcomes of the LTCM crisis as a case study for understanding financial regulation. Analyzing how regulations change in response to financial failures can provide important insights into the role of government and regulatory bodies in maintaining market stability. This knowledge is essential not only for finance professionals but also for individual investors navigating these regulated environments. Taking lessons from When Genius Failed and incorporating them into your personal finance regime can be a game changer. And here's how you can do it. First, understand the importance of risk management. The book vividly illustrates the downfall of long-term capital management (LTCM) due to poor risk management strategies despite the involvement of Nobel Prize-winning economists. This teaches us to always prepare for worst-case scenarios in our financial endeavors. Next, diversification is key. LTCM's heavy reliance on specific market behaviors led to their downfall when those expectations failed. For personal investors, this means spreading out investments to reduce potential risks. It's not just about stocks and bonds. Consider real estate, commodities, or even new sectors like technology or renewable energy. Leverage is a double-edged sword. LTCM's downfall was accelerated by excessive leverage. In personal finance, while leverage can magnify your returns, it can also magnify losses. Be cautious with how much debt you take on, whether it's for investing in the stock market or buying real estate. Stay humble and keep learning. The LTCM team, despite their brilliance, became overconfident in their models. As an individual investor, always stay open to learning and adapting. The market evolves and so should your strategies. Finally, keep an eye on the macroeconomic environment. LTCM failed to adequately account for changes in global financial markets. By staying informed on economic conditions, you can better prepare and adapt your investment strategy accordingly. Remember, information is power in the world of investing. When Genius Failed offers several invaluable lessons for anyone interested in finance. Lesson 1. Never underestimate the impact of external economic factors. LTCM's collapse was partially due to unforeseen global economic events. Always consider the bigger economic picture in your financial planning. Lesson 2. Over-reliance on historical data can be perilous. LTCM based many of their strategies on historical market behaviors, which proved to be their undoing when market conditions changed unpredictably. Use historical data, but always be ready to adapt to new information. Third, transparency with stakeholders is crucial. LTCM's secretive nature and lack of transparency with investors compounded their problems when things started to go wrong. Regular, honest communication can build trust and aid in times of crisis. Fourth, the importance of liquidity. During its crisis, LTCM found much of its portfolio was in non-liquid assets, making it difficult to cover losses. Ensure you have sufficient liquidity to handle emergencies. Fifth, the limits of diversification. While diversification is generally advisable, LTCM showed that it's possible to diversify poorly. Be thoughtful about how and where you diversify your investments. Thank you for joining us as we delved into the powerful financial lessons from When Genius Failed. If you found this video helpful, don't forget to hit that like button and subscribe for more insightful content. We'd love to hear your thoughts on this topic, so please leave a comment below. Also, check the description for links to more resources, books, and details about the broker app MooMoo. Sign up today and you could win an Apple stock and get up to 10 free shares. Thanks for watching, and we'll see you in the next video where we continue to explore secrets to unlocking your financial potential.